Hey everyone, check this out. This is my income tax return for last year. And according to my accountant, I owe a whopping $0 in taxes on my real estate gains for last year. And in fact, every single year I've ever been an investor in real estate. How could that be? Am I going to jail? Well, no, not at least for tax fraud. The reason why that is legal is because of something called the 1031 exchange. But don't get too excited if you're somebody who wants to get into real estate investments, because it looks like that could potentially be going away, along with several other proposals such as doubling the capital gains tax and eliminating something called step up in basis. I'm not commenting on whether or not those things are good or bad. I'm simply telling you what is happening right now politically with Joe Biden's new proposal, the American Families Plan, which aims to change the entire game of real estate investing for those people who either want to begin it or already have real estate holdings. I'm going to tell you all what's happening in the latest proposal and how you can prepare for it and what the chances are that this actually passes in this video. My name is Kevin Conway. I'm a real estate investor full time, and I do this little YouTube thing on the side. So please give a like to this video if you want to see more videos like this, and be sure to share it with anybody that you think it might benefit, and comment below with any questions that you have. I really love this stuff a whole lot. Real estate is what I do full time. Now let's get right into what the latest is with President Biden's proposal. So he's proposing in the American Families Plan to raise trillions and trillions of dollars of revenue to spend on programs from roads and bridges, rebuilding, and electric station infrastructure for highways, and of course other things such as elderly care and child care as well. But that money needs to come from somewhere. So he's raising taxes and he's closing so-called tax loopholes. These tax loopholes have been around since the very beginning of the income tax code. Specifically, there's a code in the IRS called Section 1031. Now, what is Section 1031? That is where the real money in real estate is made. Section 1031 is something that is just brilliant if you are a real estate investor or somebody who wants to generate a lot of wealth. I personally know many people who've made tens of millions or even hundreds of millions of dollars using this specific provision in the tax code. Now, before you get too excited, what is it exactly? Well, 1031 is the section of the tax code that allows you to not pay any taxes on your real estate gains if you do certain things. So what does Section 1031 say? It says that if you have a piece of real property and it gains in value and you sell it, and then you buy other real property with that gain and whatever you sold it for in a certain period of time, you owe zero in taxes. Yes, it really is as good as it seems. Zero in taxes is what you owe today. Of course, it is technically deferred until later, which we're going to discuss later in the video and the implications of that. But there's ways that families use this to generate enormous amounts of wealth over their lifetimes. It really is astounding. That is the way the tax law has been for a very long time. But of course, it is up for debate as to whether or not it should stay in this newest version of Joe Biden's proposal. So let's run through an example of Section 1031 that may affect somebody like you. Say you're just beginning in real estate investing and you buy a single family home that you rent out to people. Well, say you buy that home for, call it $200,000. You buy it for $200,000 today, and let's say that you bought it with, say, 20% down. So you only put $40,000 down, and then you had a mortgage for the rest. You hold it for a period of time, and that $200,000 home goes up in value to $400,000. And let's just say that you've paid off all of your debt in that time period. You paid off your mortgage on that time period. So your $200,000 home goes to $400,000, and now you have $400,000 of equity. That's pretty good. But one of the beauties of real estate, as I previously talked about, is using leverage to your advantage. You can borrow money very cheaply to buy more real estate, which pays you more in rent and has more appreciation potential than just putting all of your eggs in one basket. That's what you decide to do. So you sell that $400,000 home and you buy a few more single family homes with that equity. Again, putting 20% down. 20% down of $400,000 buys you up to $2 million of real estate. So now you have $2 million of real estate on $400,000 of equity, and you did that using Section 1031 because you sold your $400,000 home and you rolled the money over into other real estate investments. Now you own $2 million of real real estate and you didn't pay taxes for doing that transaction. Now compare that to something like stocks. If you had the same exact scenario where you had $400,000 of stocks and you wanted to lever it up and go buy more stocks, well, you would do so by selling it, but then you would owe capital gains taxes on your appreciated shares. If your shares appreciated enough, you could owe up to $100,000 or more in taxes, a tax that you wouldn't owe if you had the same exact strategy, but you applied it in real estate using Section 1031. There are several other small provisions that you need to adhere to in Section 1031, which I won't go into in this video, but just so you know at a high level, you basically need to do so in a limited period of time. You need to make that transaction within 180 days. And actually, from the time that you sell your first property to the time that you identify your other properties can only be 45 days. Again, this is technical and beside the point. So many people use this all the time. Again, I know many people who've done this very thing. In fact, just a few weeks ago, I helped a ton of clients, around 50 of them, do a 1031 exchange where we all bought an $85 million apartment building in Arizona. It's a beautiful building and no one paid any taxes in order to get into that building and now have rent potential in the future. So you may be asking yourself, is that all I need to know? I don't pay any taxes? Well, like I said before, you actually defer your taxes into the future, which means that you owe them at some point in your life when you actually sell that last property and then you don't buy a subsequent property. You would owe taxes on that transaction and every single other transaction that you made up until that point using 1031, all in that final transaction. Plus, you'd owe something called depreciation recapture, which is a technical thing, which basically means you owe just a whole lot more taxes than you would like to pay otherwise. Now, that's if you sell it and you don't buy a future property. But what do the people who have a ton of money, what do the generational wealth people do all the time to not ever pay that tax in the first place? Well, first off, they of course use 1031 to buy more and more property over their lifetimes. And then they do something that doesn't sound as fun, and that's to die. Very wealthy people, like everyone else, they die, except when they die, they actually make money. Now, how could that possibly be the case? Well, of course, you're going to owe estate taxes and other things, but as it applies to the 1031 exchange, people die and then their heirs, whoever inherits their property, get what's called step up in basis, which means that, remember at the very beginning in our example, when you bought that home for $200,000, very beginning, and you put down $40,000. Well, your basis in that building was $40,000 because that was your equity in that building. But you went ahead and you exchanged and you exchanged and you levered up over your lifetime, you paid off your debt, and now all of a sudden you control, let's say, $2 million or more in property. Well, your heirs would have to pay taxes on the difference between $40,000 and whatever equity they had in the building. Let's say they had no more debt. They would have to pay taxes on the difference between $40,000 and $2 million. Now, that's pretty hefty if you have to pay all your taxes in, plus your depreciation recapture, unless you have what's called step up in basis, which means your heirs, whoever inherits your property, would get a step up in basis, meaning that $40,000 is no longer the calculation. You actually push it all the way up to market value at the time of your death. So if you inherit $2 million of property, your basis goes to $2 million. And then if your heirs decide to sell the property, then they pay a whopping $0 in taxes. And yes, it's really as good as it seems. You 1031 exchange, you buy, you borrow, and then you die. And that's really the phrase buy, borrow, die. The last part is, of course, not as fun, but that is really how these families make so much wealth over their lifetimes. And Joe Biden's proposal actually aims to eliminate that piece as well. So he wants to eliminate the 1031 exchange, plus he wants to eliminate the step up in basis. So no longer is it the case that your heirs would inherit your property and they would get a step up in basis to market value. They would pay taxes as if they had the basis that you had in the very beginning, and they would pay all of that gain. Now that's number 2 on the major changes that affects real estate in Biden's proposal, but there's also a third one, and that is the doubling of the capital gains tax in the first place. Currently, with the surtax on there of the Obamacare, you're looking at around 23.8% in top capital gains taxes at a federal level, and he is proposing doubling it to 43.8%, give or take. Now, if you're in a state like California, you add on your income tax on top of that, and there's no deduction for state income tax past $10,000. So you're looking at close to 55% gain, 55% tax on any gains that you have that are on a long-term basis. That right there is pretty brutal, and that is really the last piece that's significantly going to affect you if you are using real estate to create generational wealth over your lifetime. What do you guys think of these new proposals? Do you think they're good? Do you agree with some of them, like eliminating the exchange or eliminating step-up basis or increasing capital gains? Let me know in the comments below. And again, this video is not meant to be political. I'm just telling you how a lot of people make a lot of money, and if the rules don't change, this is what you should do. And if they do change, you should definitely be aware of it if you are a real estate investor. So what is the likelihood that the 1031 exchange and the other things such as step up in basis and capital gains increases actually materialize in effect? Well, first off, the capital gains increase, I think it's almost certain that we do see a capital gains increase, at least at some level. Many people like Joe Manchin have said that he's in favor of a slight increase, but not a massive increase to 43%. I think we settle somewhere in the high 20s, maybe 28% or so. So that one's off the table. I think that's almost a certainty. That's pretty easy for most people to wrap their head around. Now let's talk about step up in basis. This right here is actually pretty interesting because it's been talked about before, specifically in the late 70s, as to whether or not step up in basis should be repealed. It's basically been around since the very beginning of the tax code, and it's always been talked about as something that is unfair to especially wealthier families who should pay more in tax. But the problem is, because it's been around for so long, accountants all around the country have said, look, I'm not going to keep track of the basis that my client purchased a piece of art for, or a property for, or a stock for, because it doesn't matter. When they die, they're going to give it to their kids, and we're just going to claim it at market value, and that's going to be their basis. So what's actually really interesting, and what doomed the step up in basis discussion in the late 70s, was the fact that many accountants didn't actually have records of what the basis of their clients' assets were in the first place, and that ultimately sealed the deal for step up and basis. Now, of course, the government could create a formula that you use to determine your basis if you can't find it, but I think step up and basis elimination, which has been the bedrock for estate planning for so many people for so long, I think ultimately that goes by the wayside as well. It is too complex. Now, what about 1031 exchanges? Now, this right here, I think there's almost a 0% chance that it is eliminated. Of course, it could be modified in some way. And by modified, I mean that it could apply to only certain pockets of money, but not others. For example, it could be limited to the first $500,000 of gains, but nothing more than that. Just like if you're married with a spouse and you own a home, the first $500,000 of gain is tax-free. I think that could stay with the 1031 exchange. And of course, that would help individual investors, people who have single-family homes that they exchange, et cetera, and grow a little bit of wealth and not actually get them out of this wonderful system. But it would allow wealthier families to pay more in tax. I think that is a potential. I don't know if it's likely given where we are today, but of course, people who say, no, the 1031 exchange shouldn't be eliminated at all, they cite a few key statistics. First off, you have the massive job creation that the 1031 exchange allows. You have people, everyone from title companies to 1031 exchange accommodators to real estate brokers, and everyone in between who gets paid whenever a piece of property is sold. And those people, they of course pay their income taxes on their profits that they make in your transaction. Secondly, you have the added quirk that if you own property, you could exchange it and not pay any taxes and buy more property, or you could do something which is to borrow against the value of your property to buy more property. In America, borrowing against something and having tax-free loan proceeds is just that. It's tax-free. So if I borrow against a piece of property I have no debt on, say it's a $2 million property, I have no debt, I borrow $1 million against it, that $1 million that I put into my pocket is not taxable because it is borrowed against my property. So the fear is people will just not exchange their property, they'll just borrow against their property, still pay no taxes, plus there's nothing that occurred. So there's no real estate brokers that get paid, there's no title companies, there's no any of these things that ordinarily would be the case if you sold your property and exchanged it. That would be paid, you would just borrow against it, and then when you died, you would have the added benefit of using your proceeds to pay back those those loan proceeds against your property and pay nothing on those as well. Third, it would create a stagnation in the market where there's already so few homes on the market today and so few buildings on the market today. Fewer buyers would have, fewer sellers would have any reason to actually sell their properties in the first place if they had to pay taxes on it, especially taxes that could be as much as the value of their equity in the first place if they've exchanged it over a long period of time and have to pay depreciation recapture as well. So fewer properties would go on the market, which means fewer properties would trade hands and potentially fewer properties would actually be improved or developed upon. What do you guys think of all of this? Let me know in the comments below. I just had to make a video on this because, again, it affects me every single day. I actually work on this all the time and I found it fascinating. So if you have any questions or if I didn't explain something well enough, please let me know in the comments below, and be sure to share this video with anybody that you think it might benefit, from people who are just looking to get into investing to those people who own property right now. I would love to hear from all of you out there, and please give a like to this video, and I'll see you next time. Thanks.